Imagine this, in just 4 days, on January 8th, 2026. A silent mechanism buried deep within the world's largest commodity index will trigger the forced sale of over $5 billion worth of silver contracts, flooding the market with paper positions that no one truly wants to hold. This isn't a panic sell-off driven by fear or economic collapse. It's a cold, calculated rebalancing act by passive funds tracking the Bloomberg Commodity Index, designed to realign weights after silver's explosive rally last year. But the fallout could wipe out billions in value for unsuspecting investors, clinging to digital promises of metal they'll never touch. If you're holding paper silver through ETFs or futures right now, this could be the moment your portfolio craters. Prices plunging in a liquidity vacuum as institutions dump en masse to meet arbitrary targets, leaving retail traders like you scrambling in the ruins. But here's the twist that changes everything while the paper market burns. Physical silver holders might watch their stacks soar as the decoupling accelerates. Premiums exploding, and real metal becoming the ultimate refuge in a system on the brink of fracture. Stay with me through this journey, because by the end, you'll understand not just why this dump is inevitable, but how it exposes the fragile illusion of the entire silver market. And what you must do before the exits slam shut, potentially transforming your financial future in ways the mainstream media won't dare whisper. As we stand here on January 4th, 2026, the silver market hums with an eerie calm. Spot prices hovering around $72 an ounce after a monumental surge that saw the metal more than double in value over the past year, driven by insatiable industrial demand from solar panels, electric vehicles, and AI data centers that devour the stuff like never before. Yet beneath this surface, stability lurks a ticking clock, set to detonate in the form of the annual Bloomberg Commodity Index rebalancing, a process so mechanical and predictable that it's almost invisible to the average investor until the damage is done. Picture the index as a massive basket of 24 commodities, from oil to wheat to precious metals, with trillions in passive funds mirroring its composition to give investors broad exposure without the hassle of picking winners. Silver, thanks to its stellar performance in 2025, outpacing even gold with gains over 140%, now commands a bloated 9% weighting in the index, far exceeding its target for the new year of just under 4%. To fix this imbalance, funds must sell off excess positions. And analysts at JP Morgan estimate this could mean liquidating around $3.8 billion in silver futures contracts over a mere 5 trading days starting next Thursday. Though some sources peg the figure even higher at over $5 billion when accounting for broader market flows. This isn't optional. It's baked into the rules of these behemoth indexes, forcing sales regardless of market conditions, sentiment, or fundamentals, creating a self-fulfilling prophecy of downward pressure that could shave 10 to 15% off paper prices in a heartbeat. But why does this rebalancing hit silver harder than most? Dive deeper, and you'll see the metal's unique vulnerability stems from its dual nature. A part industrial workhorse, part monetary safe haven, amplified by a market structure riddled with leverage and opacity. Last year, as global supply chains strained under a structural deficit where demand outstripped mining output by hundreds of millions of ounces, speculators piled into futures, pushing open interest to dizzying heights while physical inventories in COMEX vaults dwindled to decade lows. Barely 32 million ounces registered for delivery against claims on 800 million ounces in paper contracts. Now with the index reset looming, those same passive funds, managing assets for pensions, sovereign wealth, and everyday 401ks, have no choice but to unwind, selling into a market already jittery from recent volatility. Just 2 days ago, on January 2nd, silver climbed as much as 4% before easing back. A preview of the whipsaw swings to come as traders front-run the event, positioning for the deluge. And it's not just Bloomberg. Rival indexes like the S&P GSCI are undergoing similar shifts, potentially compounding the sell-off across the board, with estimates suggesting up to $6 billion in gold futures could also hit the market. Though silver's thinner liquidity makes it the prime victim. This forced dump isn't about bearish bets or economic doom. It's pure technicality. A reminder that in the world of high finance, algorithms and rules often dictate reality more than supply and demand. As the calendar flips closer to that fateful window from January 8th to 14th, whispers on trading floors and X feeds are growing louder, with analysts warning of a dramatic repricing lower that could see silver test support levels around $60, erasing weeks of gains in hours. Think back to similar events in early 2022. Nickel's index rebalancing contributed to a squeeze that halted trading and canceled billions in deals. Or the 2008 crisis where commodity funds liquidated en masse, cratering prices before the real recovery began. Here, the stakes feel even higher because silver's rally wasn't just hype. It was fueled by a genuine supply crunch, with India's vaults draining London's physical stocks, and China's refiners hoarding for their green tech boom. Yet this rebalancing ignores all that, treating silver like a line item to be trimmed. potentially triggering stop-loss cascades from retail traders who bought the dip last month, only to watch their positions vaporize in the liquidity death spiral. On X, posts are exploding with alerts. One trader noted the repo market's 51 billion spike overnight as a sign of hidden stress, while another highlighted JP Morgan and HSBC quietly exiting COMEX roles amid Basel III mandates, signaling banks themselves are bracing for turbulence. This isn't random noise, it's the smart money positioning, knowing that when passive giants move, the ripples turn into waves that drown the unprepared. Now, let's pull back the curtain on how this index machinery actually works. Because understanding the gears reveals why paper silver holders are about to feel the crush, while physical stackers might emerge unscathed, or even triumphant. The Bloomberg Commodity Index, or BCOM, resets annually to reflect long-term production weights, preventing any one asset from dominating after a hot streak. Silver's overweight position, swollen from its 140% surge, means funds tracking roughly 100 billion in assets must sell to drop its share from 9% to 4%, executing trades in a narrow window to minimize slippage but inevitably spiking volatility. These aren't active managers making calls. They're algorithmic behemoths like ETFs from BlackRock or Vanguard, programmed to mirror the index blindly, dumping contracts into the COMEX pit where liquidity is already strained by delivery demands hitting 15% of open interest, far above the norm. The result? Bid-ask spreads widen to dollars per ounce. Prices gap down, and margin calls from the CME, already hiked twice in recent weeks, force even more liquidations, creating a doom loop where selling begets selling. But here's where the narrative fractures. Physical silver, the bars and coins you can hold in your hand, operates in a parallel universe where dealers in Shanghai and London are already charging premiums of 10 to 30% over spot, signaling that the paper price is decoupling from reality as buyers demand the real thing amid fears of exchange defaults. This decoupling isn't new, but the rebalancing could supercharge it, exposing the big lie of the silver market, that for every ounce of physical metal, hundreds of paper claims exist, sustained only by the faith that no one will actually stand for delivery. Recent data paints a stark picture. COMEX registered inventories have plummeted below 32 million ounces, vanishing at a rate of 1.5 million per week, with eligible stocks frozen in private hands unwilling to sell at manipulated prices. As the index dump floods the paper side, spot prices might temporarily dip, luring in bargain hunters, but physical dealers could hike premiums further, pushing the street price to $80 or even $100 while futures languish. X threads are buzzing with this exact scenario. One post from a macro analyst warns of a liquidity death spiral in paper, while another shares screenshots of Walmart selling silver at $87 against a $71 futures quote. Proof that the illusion is cracking. For paper holders, this means potential catastrophe. ETFs like SLV could face forced liquidations at dictated prices, leaving you with cash equivalents far below what you paid. But for those with vaults full of eagles or bars, it's a validation, as the premium explosion affirms the scarcity driving silver toward $125 or more by year's end, per some bold forecasts. Yet, as we edge toward this pivotal week, a darker undercurrent emerges, one that ties the rebalancing to broader systemic risks bubbling just out of sight. Major banks like JP Morgan, HSBC, and Scotia are reportedly scaling back or exiting COMEX silver desks entirely, citing regulatory pressures from Basel III, which demands physical backing for derivatives, a move that echoes the Morgan Stanley memo leak from days ago urging clients to exit all positions before month end. This isn't coincidence, it's a retreat by the giants who know the math. Counterparty risks are spiking as short positions bleed in the shadows, with estimates of 5 to 10 billion ounces in notional exposure hanging over the market like a guillotine. The Federal Reserve's overnight repo spiked to 51 billion on January 3rd, hints at hidden liquidity squeezes, possibly tied to bullion banks scrambling for collateral amid margin calls. Geopolitically, tensions add fuel. U.S. threats against Iran could disrupt supply chains, while Venezuela's rumored silver hoards and China's voracious buying vacuum out Western vaults, creating a global tug-of-war where physical flows east, leaving paper west to wither. These threads weave into a perfect storm, where the index rebalancing acts as the spark, igniting a chain reaction that could force the CME to declare force majeure, settling contracts in cash rather than metal, shattering trust in the system forever, midway through this unfolding drama. A uncomfortable truth rears its head, challenging everything we've assumed about market fairness. This forced dump isn't just technical. It's a tool wielded by insiders to shake out weak hands before the real squeeze begins. Historical parallels abound. The 1980 Hunt Brothers saga, where exchanges changed rules overnight to crash prices and save the shorts. Or the 2022 nickel debacle that canceled trades to protect institutions. Today, with silver's industrial demand projected to widen the deficit to record levels, the rebalancing provides cover for banks to cover shorts quietly. buying back at depressed prices while retail panics. Ex-users are calling it out. Threads with thousands of views decry the fractional reserve silver system, where 337 million ounces are promised on paper against just 16 million available, a setup ripe for collapse. This contradiction flips the script. If paper crashes, it might actually accelerate the physical squeeze as disillusioned investors rush to convert, draining vaults further and pushing dealers to sold-out status. The emotional weight hits hard. For every trader watching screens bleed red, there's a physical holder sleeping soundly, knowing their asset isn't a promise, but a tangible shield against the fiat fray. As tension builds toward the climax, envision the market on January 8th. Trading floors erupt as the first wave of sales hits. Futures gapping down $5 in minutes. Volatility indices spiking above 80 as the CME's safeguards kick in with yet another margin hike. The doom loop spins faster. Stop losses trigger, amplifying the dump. Bid-ask spreads balloon to absurd levels. Liquidity evaporates, and the paper price divorces from physical reality. Spot quotes at 70 while coins fetch 90 in the real world. This is the detonation point, where the $5 billion flood exposes the market's fragility, potentially triggering a cascade of defaults as delivery requests overwhelm empty vaults, forcing the exchange into emergency mode. Analysts like those at TD Securities predict a 13% drop in aggregate open interest, a massive repricing that reshapes the landscape, dividing winners from losers based on one key choice, paper or physical. But in this chaos lies opportunity. The crash could be the final flush, resetting cycles for a parabolic rise, with silver eyeing $100 in months as industrial buyers. Unfazed by paper games, scoop up the real metal. In the aftermath, as the dust settles by mid-January, the true lesson crystallizes. The silver market, long suppressed by paper machinations, is breaking free, rewarding those who hold the tangible amid a world of illusions. If you've made it this far, you've armed yourself with knowledge the institutions hope to keep hidden. The rebalancing isn't the end, but a bridge to a new era where physical silver reigns as the ultimate hedge against debt crises. Inflation and systemic rot, whether disturbed by the manipulation or empowered to act. Reflect on this. In a system where promises outnumber atoms, what you hold in your hands defines your fate. The countdown is on. The choice is yours. Thank you for staying with me till the end. Here on The Scope, we dig past the headlines and uncover the hidden layers history tried to bury. If this documentary made you think differently, hit subscribe. Your support tells me to keep creating deeper investigations. Share this video with someone who loves powerful untold stories, and leave your thoughts in the comments. I read everyone. A new, even stronger documentary is already on the way. So stay curious, and I'll see you again soon, right here on The Scope.